what the heck happened to rates? Didn't everybody tell you that rates were going to fall? I can't tell you how many folks told me we were going to have a 5 handle on rates in 2024. Lo and behold, they're over 7. I got an update this morning. I think they repriced at least conventional at 7.03%. So let's talk to the man, myth, the legend, Jonathan from Convoy Home Loans. How you doing, buddy?
I'm all right. How are you?
I'm doing well, man. If you like it, lock it. Has never been better advice, huh?
Yeah, exactly. Literally been obviously the most tumultuous market we've seen in the last like I think 3 months. And the climb has been crazy. Over the last 3 weeks, it's just literally been like a up, 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 up situation. So a lot of our clients right now, obviously and we talked about this actually before, and I
Yeah.
think you and Dustin and I agreed that we didn't think that there was going to be like a crazy amount of cuts and rates shooting
No,
down this year. We
no,
all spoke like it might be a little bit of a taper, but it's not going to be anything substantial. We were telling everybody, hey, get used to where we're at because this is, it's actually good for us, if anything, right?
yeah,
Um, so I think that that's kind of been a change in tune for a lot of clients, and they obviously everyone has short-term memory of bad news. They all forgot what it was like 6 months ago when the market was doing the same thing, right? And we're
yeah,
basically back to where we were, in like October,
right.
of last year, which is kind of crazy because the market was, so much. It's kind of like I think the easiest way to put it is like people need to just find great deals, right? Like we talk about in the market that they're in. It doesn't like there's no waiting game anymore. There's no like,
Yeah,
hey, I'm gonna wait for things to happen. I'm gonna wait for magic to happen and things to land on my lap. It's not like that, right? The last year has showed us that, and this year is going to be even stronger. I think representation of that.
yeah. And again, we have a playlist. You have a playlist called Convoy Home Loans. People can go back because I remember that conversation. I remember saying, I don't know what the market's thinking. This is when rates were like 6.5, 6.6. And the market, I mean, I don't know. There was like, I don't know, 70% of my feed, the people I watch were like, rates are going sub 6, rates are going sub 6. And I'm like, I remember saying, I hope not. Because if they did, and they did it quickly, the market would go bananas. And I don't want to do that anymore. I've had enough of crazy housing markets. Let's baseline in the sixes, 6.5, and then let's see where the dust settles. And
Yeah, I
yeah,
mean the dust hasn't settled still,
no, it's gone
right?
up.
Yeah,
Yeah, it's pretty
it's
funny. So the thing that again, I've studied the consumer for 30 years, and you think I would stop being surprised. But here's the deal. What I saw just in the last 7 days, maybe 10 days, there were people in my network who were basically betting rates were going to 6. They had their eyes on a property. Maybe they were doing a refi. They were doing a streamline or something. And they chose to go, nope, rates collapsed. They're going to go to 6. I'll wait. Now they're over 7. And a couple of them have to buy, right? Family situations, job situations. If you like it, lock it. And it was just it was a foolish momentum bet, and it didn't pay off.
I mean, definitely not. I think the biggest thing for a lot of clients and a lot of people that I'm seeing on the market is obviously the waiting situation, but they're stubborn, right? I've never seen this much amount of clients that are stubborn about something than in the last like 10 years that I've been doing this, right? This is the most stubborn I've ever seen clients on their belief of what's going to happen. And I think it's because there's an oversaturation of gurus on the market saying that
Yeah.
things will go one way or the other. And they're like, no, 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 I saw it on TikTok. And, this guru said that the rates are going to go down to 5. And I'm like, okay, are rates really going to, you think by the end of the year, rates are going to be at 5? Like that means that the world economy has crashed.
Be
That
careful what
means
you
that,
wish for.
yeah. And that means that there's all these other penalties that come with rates coming down, right? And the biggest thing I think is if rates come down, that means that we are not doing well, right?
Yeah, certainly if they come down. Yeah, if we get a 5.0, we're in a recession.
Yeah.
The Fed's like, the Fed raises like stairs and takes the elevator down. Yeah, be careful what you wish for. We
Exactly.
probably spiked to 5% unemployment or something like that. It would
Yeah,
be
because
not good.
right now, even in the market, we're seeing this happen where, companies are doing massive layoffs and like, people are just running out of money. Everyone's tightening up. There's no way that all of a sudden, because inflation seems to be tinkering down, which it hasn't, it went up, right, last month. And I think probably February will be a little higher. But like realistically, if that keeps happening, there's no reason for the feds to be like, hey, you know what? Economy's kind of slowing down. Let's pump the market,
Yeah.
drop rates, and then make inflation go back to where it was at like 9-10%. There's no reason to do that.
No, yeah. Again, to your point, I mean, people go back and look at the late 70s and 80s. One of the things the Federal Reserve did wrong is they felt the economy entering a recession. They whacked rates. It was the 1980 recession, which was short. The economy did reinvigorate when they cut rates, but then inflation took off. And what they had to do is they had to go higher. That
Hmm.
led to a 1981 to 82 recession, which until the Great Recession was the worst since the Depression. It was 18 months long. It was tough. And yeah, the Fed can't cut early. I've been saying for a while the Fed is going to wait one extra meeting. Like if they should cut in May, they're going to wait to June. If they should cut in June, they're going to wait to September. It's just they're going to make sure they kill this thing because
Yeah.
they don't want to come back and do it again.
Yeah, and what does it really mean to kill this thing right at this point in time? Like we don't really know what that goalpost is. He does say, like Powell says, oh, inflation at 2%. But you know, I think there's
Yeah.
a lot of other factors that go into it, and we've talked about it in the past. Like it's not just the inflation number that people are seeing. We're
Mhm.
looking at all these other reports that come out that
Yeah.
unfortunately, I guess for the market, but unfortunately for real estate investors, they keep coming out stronger,
Right.
right? Like jobs reports and such. And that actually keeps Powell and the feds from being like, well, we
Yeah.
don't really need to cut rates.
Yeah.
We don't need to
Well,
stimulate.
yeah, exactly. Yeah, I
Yeah.
mean the jobs report was strong last month or whatever was reported. CPI came in stronger than expected. The other thing that's really interesting that we haven't talked a lot about here is the Fed actually pivoted from 2% inflation to 2% average inflation, which is a new wrinkle in this mess. So we're not really sure how that's going to play out. We do know that they'll start cutting before it hits the 2% number. I think that's pretty clear. But yeah, the market has been reaching, and I think that's what caught a lot of people off. Is 6 weeks ago, I think the market was pricing in like 7 rate cuts, and that had to be where people were getting this 5% call. You and I again in Dustin were like, no, 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 three, maybe four. And now fast forward, they're talking three or four. So, um, yeah, I think there's a lot of to your point. They were stubborn, or they just believe everybody believes like their thing,
Hmm.
and they don't straw man or steel man the other side, steel man the other side. So you guys, you gotta look at the other side, even if you don't agree. I think sometimes it's interesting just to understand what the other side is saying.
Yeah, it's funny because we've always said, if you go back to all our videos, we're always like, if you like it, lock it. If you like it,
Yes.
lock it. If you like it, lock it. Like, because we know that like our belief is, I guess we're a little more conservative, but I mean, we've seen the market do the crazy thing over the last 3 years, right?
Yeah.
A lot of mortgage people that are telling people like, hey, you're gonna go ahead and like market's gonna shift up or shift down, and rates are gonna go down, so keep it floating. Like people, mortgage professionals that are telling you that, like, and real estate agents, like, don't trust them. They
Mhm.
they they are just trying to catch something that they think, but if they've been like watching the market, or it's just numbers, right? It's just data.
Yes. Numbers. Yeah.
Like over the last year, like if something happens, then we're gonna, it's literally gonna swing up or down. There's no way for us to really tell, right, with certainty that the market's gonna move one way or the other, you
Yeah.
know? So
Folks, run your great deals with current rates. That way, you know the worst case scenario. Don't. I mean, the last thing you should do is, oh, I'm going to run my rates at 6.5, and even though we're at 7, that. Don't do that. Run them with the rates that you have today. To that
correct.
end, if somebody wanted to reach out to you and figure out what their situation is on their deal with their credit profile, how do they do that?
Go to convoyhomeloans.com and let us know you came from ORAT.
There you go. Well, let's
Yeah.
talk about something else. There's been a couple of times. So let's do this. Normally speaking, conventional loan interest rate is below DSCR loans. Makes total sense. Different risk profile, different everything. There's been a couple of times in our multi-year conversations that you're like, Zuber, DSCR loans in this situation are cheaper than conventional. So I'm curious, what's going on today?
Yeah, I mean, it was crazy because obviously we've seen a lot of and again, inverse yields on the 5, 7, and 10 year, which is kind of affecting the commercial loan
Mm,
market and causing like the 5, 7, and 10 year loans to basically be the same rate almost.
wow.
But like on our side, because the market has kind of been kind of all over the place and non-QM, like we've spoken in the past, doesn't adjust as fast as conventional does. So if the conventional market jumps, 30 basis points in a day, the non-QM market is not going to jump 30 basis points in that day. In fact, actually, what's kind of interesting is, and we've talked about it previously, non-QM is a lot tied to Wall Street, and Wall Street believes that we're in a position where, like, longer term wise, the rates are going to average out to where it's going to be. So when the rate shot down, the market on the non-QM side didn't shoot that down, right? They
Right.
pretty much stayed pretty level to where they were. So they already priced in everything that, the people were reacting about. And now we're in
Right.
a situation where, because that happened and a lot of this was priced in, and now the 10-year treasury just jumped back up and all that happened, the non-QM market in some pockets of, in a lot of pockets, actually, anything under like 70%, even 75% LTV, and if the debt coverage is good, the rates are actually ending up better than
Mm,
conventional, because we could, like, yesterday, oh, actually, it was crazy. I did a 70% cash out DSCR loan at 6.75. And
wow.
the client only had to buy down like half a point to get to
That's crazy.
6.75.
On a
On a
cash out.
30-year fix, cash out, 70% LTV, right?
Wow.
That same scenario in a conventional sense would at least be 7.5, 7.75.
Oh, yeah.
So, and
Wow.
it was a bigger loan. It was a jump. It's like 1.5
Mm,
million, something like that.
wow.
So it's kind of crazy where that's where we are at now, but that's because we've been talking about this. Go back on our playlist, literally, like, non-QM doesn't move as quick. But
Hmm.
right now is the time to capitalize. Like, if you like it, lock it right now. If you
Yes.
get
Yes.
into a non-QM program that price is better than conventional, this is the
Take it.
time to lock it in. You
Yeah.
know,
If
even
you're in
with
that situation, what so non-QM would be self-employed, some S
DSCR,
DSCR, yeah.
yeah, bank statement, P&L, stuff like that.
Yeah.
But this is the time, and it's kind of scary to say that, because we keep going back and forth between conventional and then non-conventional, but you have to play your cards like you talked about.
Yeah.
Play your
Yeah.
cards to the market today. Don't play your
Exactly.
cards to the market what you think it's going to be in the future. What it was in the
Yeah.
past. None of that matters.
Yeah. This ain't tarot cards. We ain't, we're not psychics. We're just
Yeah,
playing with the numbers
exactly.
and deals we had today.
Exactly.
So that's pretty cool.
Exactly.
So convoyhomeloans.com. Let them know it came from ORAT. They can look at their DSCR or conventional loans. And that's the beauty of Convoy being here each week. I appreciate you because you do offer all of that. Let's kind of close out on a topic that hopefully is near and dear to everyone watching. What are the good real estate investors doing today? Right? Because I see this all the time when the housing market and or the lending market gyrates. A lot of the new folks wig out and disappear, and the good ones, they're frankly like a duck, right?
Mhm.
They may be their feet may be moving a lot, but you couldn't see them sweat. What are the good ones doing?
I mean, your analogy is almost perfect, because ducks, when they're waddling, they're kind of staying above the water. And
Yeah,
then what I've seen them do is they'll stick their head down to get some food,
yeah, they're like,
right?
oh, I see one.
Yeah,
I get that one too.
exactly. Exactly. While everyone else is like, they're kind of living under the water, right? They're like trying to find something to kind of grasp on. And the good investors, the good clients that, that are very successful that I have, are just kind of sitting and waiting, making aggressive offers, And then
Yeah,
if it only if it makes sense, do they accept?
exactly. They know their
Only.
numbers.
Yeah, only if it makes sense. Because at the end of the day, like rates are like we've talked about this, rates are just the cost of money. It's just the
Yeah,
cost of capital. So
yeah,
if it makes sense and it cash flows at that certain rate, at that certain number, then that's when you go underwater and grab the, little food
yeah,
fish that you need to
yeah.
catch. But if it's not that case, there's no reason to stay underwater trying to find something and force something to work. Right.
Yeah.
And yeah,
Yeah, when I look at the market, I think there's a couple of things that I see the good ones doing. One is they don't chase fads, right? Um, think about Airbnb in Palm Springs, for example. Definitely a fad. Some regulation and all that went against people. I know there's this house that I've seen all over Twitter, I think, that once sold for 660, just resold for like 360 or something.
crazy.
Just crazy. Um, so they don't chase fads. Second, they know their numbers. Third, they're not opposed to doing the work. What I really love about the duck analogy is it really doesn't matter what the day is. They're doing the same thing,
Hmm.
right? They're not distracted by all the nonsense and craziness around them. And they're just writing deals that make sense for them with the current cost of capital. I will say when lending markets change, it's definitely in like the small multifamily, 5 to 40s. The good ones, hopefully like me, we're looking to do creative offers to stand out. What do I mean by that? Something I'm doing today is I want to let all the multifamily investors in California, but really the Central Valley know I will overpay for a multifamily property. Now, obviously, there's a comma in that.
Yeah. Yeah.
The comma being you're going to have to do seller financing and I'm going to get a below market rate because my intention is to hold forever. I'm not a syndicator where I have to return capital. So if we can work out a win-win deal where you get a price that is above value, but I get a below market interest rate for 30 years or 40 years or whatever we agree, we can structure a deal we're both happy with. So again, I think the good ones really let the market help them, right?
Yeah.
Sometimes it's just cash and speed. 2020, cash and speed. Today, a little bit of distress. Lending market's not as easy as it was. Well, let's go figure out if we can do some seller financing. So I think the good ones are, I'm excited by what's coming, frankly.
Yeah. And to your point about using like the market and the tools that are currently there, right? Seller financing is one of them. I'm actually writing a lot of bridge loans.
Okay.
Uh,
Tell me about that.
and obviously those are the shorter term loans. You can finance rehab, you can finance all of that. I'm writing a lot of those.
1 year bridge, 1 year or two?
Yeah, 1 year.
One
Because
year
they're
bridge.
buying
Okay.
slightly distressed properties. They don't want to put all their capital
Ah,
into the property. So they'll buy it below market that's been sitting on the market for like, I don't know, some properties have been sitting for almost a year. Like some
so
people
tell
have.
me. So I like this because this again is letting the market tell you where to hunt, right? Where
Mhm.
the fish are. And I agree with you. I almost took down a 4 house package because the properties were in rough shape. And the rough numbers are ARV would have been $1 million all in. I was trying to get it for 650 after inspections. I wanted it for 600. Now we didn't agree on the 600 number, so I walked. But this is why a bridge loan could have worked, right? I could have done it. They would have all been, I don't know, 90 to 180 day flips and then exit. They were all would have been below the median and it could have made a lot of sense. But so bridge
Yep.
debt on distressed assets makes sense if
Yep.
you have the
And
skill and experience.
exactly, exactly. In the right guidance, right? I mean, people are always looking for highest leverage when it comes to bridge. Like they will shop me because someone will give them 5% more leverage. But I'm like, just because they give you 5% more leverage actually doesn't do
Yep.
you any good at the end of
Yeah.
the day.
Yeah.
Because the risk is just higher. The risk of default, the risk of not being able to make your equity back, like that. That's why so
Yeah.
many of these properties are sitting on the market wanting to refinance out, but can't even refinance out into long
Oh
term.
yeah. Yeah. Yeah.
It
That
is
that would hurt. You're in bridge debt or hard money and you can't refi out.
exactly.
Oh, that'd be painful.
Yeah. And that's mostly because people are just like they want that high leverage. They don't want to bring that money out of pocket, but it's like that money out of pocket is what you need to make
Security.
feels
Yeah.
good and
Yeah.
you have an exit.
I hate
So
max leverage. I just it just
yeah,
screams
exactly.
risk.
It's too much risk. And a lot of deals that we're looking at, like I'm doing a lot of mid construction stuff too, mid rehab stuff.
What is that?
Um,
What is it? What is that? So it started with some other lender and they came in, or
correct.
what does mid
It-
construction mean?
So it's like they were starting to do the bridge, right? And then
Mhm.
it took longer than they expected, more
Oh,
money
you got
than,
to go bridge to bridge?
yeah, now it's a bridge to a
Ooh.
bridge. But
Oof.
what actually works for a lot of clients is like they're at the tail end of finishing everything. They
Right.
they have basically everything almost done. Walls are up, flooring's done, but then they're like, okay, now I want to tap into a little more equity because now it has more equity than it did previously
Mm,
when they
okay.
first did the ARV and as is
Oh,
valuation.
I got it. I got
So
it.
now they're tapping into a little more cash to get, immediate money to work on it and then a budget as well to do it. Obviously, it's like leverage on leverage. So it's a little risky, but at the same time, if you bought something at a big enough discount, right?
Yeah. It's all
Like
about the price point. Yep.
it can make sense, right? Like I'm working on something right now in Pasadena. It was the client bought it at like 2 million, but it's worth like as is, just as is was worth like 5.5. So
Oh, no, plenty of room. Yeah.
he has plenty of room, right? So this is kind of like a situation where it would make sense to,
Yeah.
okay, you bought it at such a low price that even if you have a little bit of equity that you want to tap into later, you could tap into it. And if you need to go to market and sell it, if you list that thing for 5 million, it's gone,
Yeah.
right? So yeah, and I'm doing a lot of projects like that. Same thing, another house in Malibu doing the same thing, right? We just finished on it. They needed landscaping, right? They were like
Mm,
finished everything, and then they needed landscaping to sell the property at a higher valuation.
right.
And they didn't have the cash to do landscaping. So we came in and gave them the money to do the landscaping and then put it on a bridge to sale where they can list it while having the loan done without a
Nice.
prepay. And then their
There you go.
equity's still there. We only lent up to like, I think like 65% or whatever. And then they just
Yeah.
pull out the equity when it's done.
There you go.
Yeah.
Yeah, at the end of the day, folks, Convoy Home Loans is there. They will help you evaluate your deal, give you options. Maybe, again, it changes all the time. Maybe DSCR better than conventional. Reach out. One more time, where should they go?
Go to convoyhomeloans.com and let us know you came from more at.
All right, buddy. Thanks you, and we'll see you in
Thank
Vegas,
you.
man.
See you soon.
All right.